Your next lesson. Today we're going to go over risk sentiment, and obviously I'm Mark Fraser. Drew has obviously gone through all of the other aspects of the fundamentals: GDP, inflation, interest rates. So what we're going to cover is obviously risk sentiment. This is something that is quite important to understand in trading. We've all experienced any sort of risk sentiment at all times during the markets. So let's run straight through it. So risk sentiment. This is one of the only factors to throw a fundamentally strong economy or currency off its course. Risk sentiment is the general attitude or thinking on investor and market participants with regards to taking on risk in the financial markets. Risk sentiment would be factors like political events, global events like COVID-19, and even economic data that can throw off an economy. When sentiment is in favor of risk, i.e. risk on, investors are more likely to buy what's known as risky assets, such as stocks, or risky FX like CAD. We'll get onto this later. When sentiment isn't in favor of risk, i.e. risk off, investors are more likely to be defensive and will put their capital into assets that doesn't really yield as much profit, but generally always performs well in risk off. This could be assets like bonds or the US dollar. As traders, we must respect that risk sentiment is a key addition to our trading toolbox. So in simple terms, risk sentiment is the overall mood or appetite that market participants have towards risk. So let's look into risk sentiment a little further. As we know already, risk sentiment is determined by a number of factors such as geopolitical tensions, war, etc. Ask yourself, does this event create worry or optimism in the region? So of course, we have here a war, for example, like the war we have in Ukraine at the moment. Does that create optimism or does that create worry? And that obviously creates worry, and anything surrounding the war or anything that's affected by the war in terms of an asset class like, for example, euro, given the fact that it's just so close to the war, that creates the worrisome, and that's why we saw a big euro weakness during the time that Russia invaded Ukraine, and of course the surrounding currencies as well as risk. We have elections, anything along those lines that can create some sort of worries, and of course the virus that will create worry as well. So there are two time frames of risk sentiment. We have short and long-term risk events. Short-term risk event would be events or news like earnings reports from companies or policy announcements that government may do. This in short term because market participants may get scared in the short term because it's a new uncertain event. Long-term risk sentiment refers to events that's going to cause investors to be very uncomfortable for a sustained period of time, such as a recession or most recently the war in Ukraine or COVID-19. So let's say the global risk sentiment is risk on. However, the economy may experience short-term risk off due to political pressure. You'll expect the currency to weaken in the short term, but then appreciate once the market is over. So like, for example, if we show you here, we have the elections or the US elections of 2020. This is euro dollar. So of course, during the time it created just worrisome, people weren't really wanting to get into any sort of positions here. Of course, it wicks through, obviously takes out liquidity, but as we can see, it just created worry. People didn't really want to get into any sort of positions here. So during the 2020 elections, this is a short-term risk move since investors are unsure who will win and what new policies that they will bring to the economy. So it's about, are they going to be cutting taxes? Are they going to raising taxes? What are they going to be doing with employment, etc.? And people are just worried. Euro dollar, of course, October/November 2020 price action. As you can see, it was choppy. Markets were unsure where it wanted to go. After the elections, euro dollar strengthened further. So it just continued its fundamental bias at that stage. So that's short term, right? That's not going to be something that's really going to be impacting the markets for a sustained period of time. It really just depended on who got in at the time as well, whether they brought on some new policies. But markets got over it pretty quickly. So long term. So now let's look at long-term risk sentiment example. China COVID-19 issues is risk off for risk FX. More will be explained in risk off in another session. So we're not going to go over too much of risk on, risk off today. This is just very short, very sharp in terms of what risk sentiment is. But since China is a large trading partner for a lot of commodity-based economies such as Australia, New Zealand, but also Canada too, if China has long-term issues, they'll want to spend less, thus creating less demand for the commodity currencies. Since China had their major COVID outbreak last year, we saw the currency weaken around 15%, and it lasted around 10 months as shown below in US dollar Chinese yuan. So this is a US dollar Chinese yuan here. As it strengthens up, you're essentially saying the dollar at this stage is better than the Chinese yuan, or fundamentally stronger, or has less issues. And of course, if you do flip side where it would be Chinese yuan US dollar, this will be pointing down. So you're essentially telling yourself that China is in a worse off position, which of course it makes sense because of the COVID issues. You wouldn't really want to be taking long-term positions if there's such issues with COVID in China. For example, we saw Australian dollar weaken off quite drastically for a good sustained period of time because Australia relies on China so heavily. But we'll get onto that in some later sessions. So, very quick, very short, very simple. So, as a summary, as we just learned, there are two types of risk sentiment: risk on, risk off. In addition, there are two time frames for risk, short and long term. Remember, understanding what type of environment we are in will greatly help you understand where the money will likely flow, and if traded correctly, will increase your move in its intended direction. So for example, if there's a big risk on event, China, for example, most recently, which again we'll get onto, China, of course, recovering, Australia being bought up as a result, as a big risk on. And of course, if you were selling that, it would just be a little bit unwise because Australia tends to strengthen risk on, for example.